To quote Charlie Munger and Warren Buffett, only very few people are willing to get rich in a long run. There is no academic definition for value investing, but the essence of it is to get your return from the intrinsic value of the company that you invest in, and you hold it long enough to see that increase. The fundamental for investment management or asset management industry is trust, without which everything is pointless or even illegal. When you look into our framework, you see three basic pillars. One is business, one is key management, one is organization. People is entrepreneurship, and people within the organizational structure of a corporate are, in fact, the ultimate origins of value in creating. No one can, single-handedly beat the market constantly and keep a good team going for a long time. It has to be teamwork. It has to be a partnership. Every relationship requires constant efforts and mutual efforts and constant cares. Don't take things for granted.
Hey everyone, welcome to The Essence of Investing, where we explore the stories, strategies, wit, and wisdom of investors from across Asia and beyond. I'm your host, Jonathan Reckman. My guest today is the one and only Andrew He, founding partner, chairman, and CIO of Nous Capital, a long-biased hedge fund investing in Chinese companies listed around the world. In this episode, we discuss Andrew's journey as a value investor, his tactics for assessing management integrity, his quest for true insight, and the essence of intrinsic value. We were lucky enough to record this conversation live at the Honest Drink podcast studio in Shanghai. Please listen, like, share, give feedback, and most of all, enjoy. The Essence of Investing is powered by Next Level Communication and by the world of allocators. Next Level Communication helps investors and multinational executives in Asia tell their stories to their most important global stakeholders. Get in touch at reachnextlevel.net to learn more about cross-border IR, strategic communication, and presentation training services. The world of allocators encourages long-term thinking and the adoption of the endowment approach among asset managers in China. Get in touch to join our community of domestic and overseas practitioners to share and learn.
First of all, thank you so much for having me here, John. I'm a big fan of yours and Next Level Communication. Nowadays, we need bridge builders more than ever, especially now. So good to be here. To explain my career path or my investment philosophy choice, my choice of business model, how I want to build Nous Capital, would be better start from my first job. I was equity sales for CICC in Shanghai. That was more than 10 years ago, but it sounds a little bit remote from what I do now, but really, till today, I'm still very, very grateful for that job, because from that almost 4 years experience, I got the two single most important takeaways for my buy-side career. One is to realize the difference between investing and speculating. Since QFII, Qualified Foreign Institutional Investors, the reason they got the license to invest in A-share markets at that time, there were no stock connects then. The only way to invest in A-share market for foreigners are through QFI schemes. From them, because acting as a QFI equity sales, I got to very closely to watch their daily work. I feed them with our stock picking ideas, our research works, some corporate access, some expert access from government, from regulators, and so on. So I closely work with them, and I can see their books. And they do trades through CICC as a broker. We act as a broker. So I can see everything. So it's very convenient in that position to identify what difference would it make for different investment philosophies, different frameworks, different processes, different style of the PMs, and how that would result in different investment performances. Through that work, I got to observe their framework and processes. And I made a few friends at that time among my clients. For example, like many of my framework today of Nous Capital, a big part of it actually derived from what Hill House has at that time. It really inspires me a lot. They do very incredible fundamental research. Most of them are proprietary. They don't really rely on any sell side research team. They pay a lot to their research team and to access external experts, sometimes even into the academia circle to get to the truth. And they spend a lot of efforts on analyzing people, the management, the organization, and people within the company they want to invest in. So that's really different from most of the investors do at that time.
How do you think about imitation versus innovation in terms of taking best practices that you saw at other firms and incorporating them eventually into your own? How did you evaluate what you wanted to bring over and keep the same, and where were areas where you wanted to do it differently?
I think the key idea is to do whatever makes sense. I don't think there is a standard answer in the investment world. There is no such thing as a eternally right, correct framework.
A universal best practice.
Yeah, universal best practice. There are some, I believe there are some universal best principles. There are principles that can be applied for very, very long time.
It's not because they don't understand the concept of value investing or fundamentals. It's that they empirically see in the market that momentum and, what will the next guy pay tends to be a, more immediate determinant of success than the long-term, economic reality of this business. And it feels like a shame that is so prevalent. And it also feels like a self-fulfilling prophecy. Like if enough of the market acts like that way, then it really will. And it's what causes all these bubbles. But I guess I'm curious, how much of that is because people don't understand value investing versus they understand it, but they don't believe in it, or their empirical view of the market tells them something else is at play?
I think that's simple human characteristics. To quote Charlie Munger and Warren Buffett, only very few people are willing to get rich in a long run. Most people, they want to be quick, to get rich as quickly as possible. And the secondary market, the stock market, offers limitless accesses to trade. You have to be very determined of the right investment philosophy to resist the urge to do trades very frequently.
Analyze that for me. When it's easy to look at a buy low moment and say, that's a great investor. But what was it that you saw that kind of exemplified value investing for you? Was it just buy at a low price, or was there some fundamental insight into these two stocks, into Mount Tai and Gree, or was there just a sense of market momentum? He called the bottom, and we said it can only go up from here. What made that really an impressive moment for you?
Like I said before, there is no academic definition for value investing, but the essence of it is to get your return from the intrinsic value of the company that you invest in, and you hold it long enough to see that increase, and then the stock price will reflect it, and that would bring you the return. The trick is how to accurately evaluate the so-called intrinsic value of a company. That requires systemic research work, very thorough research work on the fundamentals. You need to research on the business, on the sector, on the industry the business is in, the management, the ordinary people there, the organizations, and even sometimes macro or meso environment for that company, in order to come up with a relatively accurate valuation for that asset, for that equity. And then you buy it, hopefully you buy it at a reasonable price or low price, and then let time do the course.
You left us you were at Asia Value and during the Qiangu Tieting.
Yeah.
What happened from there?
After the stock crisis in summer 2015, I was very fortunate to get an offer from Asia Value Capital. And I immediately quit my job at CICC and also turned down a pretty good offer from Morgan Stanley Hong Kong to pursue my buy-side career. I joined Asia Value as a research analyst first, and then PM, and then partner after 3.5 years. In October 2018, I got the chance to join CITIC Capital. The reason why I left Asia Value was because I have different views on the China economy and the business model of Asia Value with the founder. So I left and joined CITIC Capital in 2018. But unfortunately, after 1 year, in late 2019, the senior management decided to spin off the whole asset management department to become a mutual fund house under the regulation of China mainland. Even though we outperformed everyone else within the department that year, we still decided to leave CITIC Capital, to leave the platform to start our own fund house because we want to undisturbedly value investing in China. And we started to believe that the only way to do so is to build our own fund house. So my co-founder Peng Fei and I, we were partners at CITIC Capital. We co-managed the team. We decided to negotiate with the senior management to spin off. And very luckily, after months of restructuring, we did a full spin-off from CITIC Capital together with our core analyst and the offshore Cayman fund that we were managing.
Was there any change in strategy from being within CITIC to coming out and spinning out and doing it on your own? Did it change the strategy, or we're doing this is what you wanted to do, and it's just CITIC moved in another direction and you stayed the course?
We didn't change the strategy. We are still a China-focused, long-biased fund. But CITIC want to do mutual fund, so it's a completely different business model, which is driven by not purely in performance, but AUM-based business.
Paint this picture for me. You and Peng Fei and an analyst come out from CITIC with a pot of LP capital and a strategy and a blank piece of paper, a blank slate beyond that. You set up your own office, build your own team, build your own culture. You're bringing over a lot of the strategy and the frameworks that you were using previously, but you're also building something fresh and new. What were those early days like of building Nous Capital as an independent entity? What were your first priorities?
Our first priority is to seize the market bottom at that time, because that was early 2020 when the pandemic just outburst to the world, and then the market fell very quickly. We believe that it was the best time within 5 years, but obviously, as we look back, there were even more bumpy road ahead. But at that time, we believed that was a good chance. It was good for our LPs to get a fresh start, to be fully invested with a value investing strategy. That's really our first priority. So our first goal is to move back to Shanghai to get our onshore fund management license. And then we launch our onshore fund as soon as possible. And at the same time, we also have our offshore Cayman fund from CITIC. We want to seize the market opportunity.
And tell me about Nous today. What defines it as a fund?
Well, that's a very good question. I think the fundamental for investment management or asset management industry is trust, is fiduciary duty, without which everything is pointless or even illegal. Which methodology you employ to manage investments for your clients is a next step. But the first step is you need to really understand what fiduciary duty means since our inception. So we are very grateful for the stickiness and the loyalty.
I hope, Trent, that sense of fiduciary responsibility and trust, translate it into some more practical action. Like how, if you believe that this is just absolutely essential, it's your number one priority, and maybe as a differentiator for your fund versus other funds that maybe, play a little looser or don't take that as seriously. Like, what do you do differently?
There's quite a lot to mention. For example, I think the most important one is do as you say, as you advertise. It's very common in my industry that people are not 知行合一 enough. Every long-only fund or long-bias fund would advertise them as value investors, but we both know there are very, very few real value investors in this market. If you look at the turnover ratio, the average turnover ratio for us is less than 50% a year. Like this year is even less than 40%. Well, for secondary market, it's almost impossible for any of your LPs to monitor you on a daily basis, right? To see if whether you are doing things that you advertise or not. So it's really on your own. The GP decide how honest they are on the investment side. That's the most important one. Secondly is transparency. To show your respect to your LPs, also to build trust, you need to get serious about transparency. There are a lot of communication required. You need to write letters on monthly, quarterly basis to your investors. You need to hold annual meetings for them to understand what you are really doing, what your views are, and the results, to explain the results in various of metrics and statistics. Those kind of transparency really help to build trust. You really need to be committing to the due diligence process for your investors. When they give you a list of due diligence questions, there are usually 30 to 100 pages easily, and you ought to answer them in details and honestly about your research, investment, and risk management, and back offices. Could
you just describe what your evaluation framework looks like? I remember you walking me through it once, the kind of multi-level, multi-tiers. Could you walk us through what your framework looks like for evaluating a target?
The highest level is 3 pillars, which is business, key management, and organizations. Each of these 3 pillars has multiple subcategories, and each categories probably have further subcategories. So eventually, it would form a due diligence list of over 300 questions, checking points, and that's what we called research manual for us. And each project we do will follow that research manual, but not necessarily take every checkpoints into the research plan.
I wanted to ask, when you're building, so a lot of work goes into the research of a company. How do you avoid the long bias that we have in our psychologies, which is to say, when you have spent all of this time working on a research project, you want it to be good.
Yeah.
You want it to go forward. You don't want to throw it all away.
Right.
You have this sunk cost of effort.
Right.
How do you correct for that bias? And in writing, they say, kill your darlings. How do you let go of companies that you inevitably become attached to?
I would say, first, you need to open your eyes to a lot more companies, so that your eyes won't be fixated on very limited babies. Broaden your radar, and then more importantly, I think we need to you need to build a system, build a mechanism to avoid those bias. For example, for us, we have two key men in the research and investment process, me and Pengfei. During the whole research process, there are 4 voting points. For example, the initiation and review of initial due diligence, preliminary due diligence, and review for in-depth due diligence, and then decide which pool the project goes to. In those 4 voting points, Pengfei and I, both of us, have vetoes. Each project will be led by either Pengfei and I ourselves or our analysts. But whoever it is, that project leader would probably have the most biggest bias for this project, right? So at those 4 voting moment, we will hold a meeting that includes everyone in the research team. There are 5 of us, and we are hiring the 6th analyst. So we will have a full discussion on the project to find out if there is any bias in it. And most importantly, it needs to get both green lights to go forward. So let's say if I'm the one who's responsible for the project, I'm the biggest shareholder, I'm the CIO, but Pengfei also get to veto my project if he thinks he gives reasonable rationales. Usually the one who vetoes would offer his concerns and challenges against this project. And then the project leader will work on it and try to resolve those challenges and concerns. If they do, then the project will get both 2 green lights. If not, it will stuck there. So that's the mechanism for us to avoid those kind of long bias.
How do you balance just your attention to going deep versus going broad? Mm-hmm. How do you do that individually and as a firm?
I understand what you call zoom out includes 3 aspects. The first one, yes, we do sometimes seek for second opinions from our group learning buddies. Sometimes they are individual investors. Sometimes they are investors from private equity industry. Sometimes they are even our competitors who have also very solid research works and who we respect and keep very good relationship with. So we will be very direct and honest with each other and cross-check everybody's homework sometimes. So during our research, if we encounter some difficulties or we have very obvious different opinions internally, we will seek for another second opinion outside. For the second aspect, we examine and adjust our research pipelines on a semi-annual basis. We'll zoom out and rethink whether the direction or the sectors we are putting efforts to are worth it with our time and resources. So we might change our pipelines sometimes. For the third aspect, we are long biased. We are not purely long only. Sometimes we will do macro risk management, risk control. If we identify some significant downside risks, the 3-year investment horizon. Typically, our investors have 3 to 5 years of investment horizon. Whenever we identify some big events or economical or geopolitical risks that might bring to unrecoverable damage to our performance within the 3-year horizon, we will do top-down risk control, such as hedging or simply cutting our position proportionally. In the firm, usually I'm the one who covers those macro to watch for those macro level big risks. Every year, I will allocate a certain amount of my time to talk to experts, to read, to analyze those kind of risks.
So there's some intentionality in setting up a space on the calendar, both for the firm to do these sectoral reviews and in your own kind of daily calendar to take time to look at the macro. And that's a very intentional arrangement.
Yeah. Besides those three aspects, there is a more fundamental reason why our strategy works is to be very, very selective for your focus on the research. For example, we focus on China and we focus only on two main sectors. One is consumer and services. The other is advanced manufacturing. Those two take up more than 90% of our research efforts.
I remember you walking me through some of the due diligence that you do on companies. And as part of that, it's highly frameworked. And part of the due diligence is on management. And part of the due diligence on management is the integrity of company personnel and leadership. I'm very interested in how you take an analytical, process-oriented methodology and apply it to something like integrity. Tell me about how do you evaluate the integrity of management teams?
Integrity is one of the four aspects that when we look into a company's key management. When you look into our framework, you see three basic pillars, right? One is business, one is key management, one is organization, meaning the ordinary personnel and the organizational architecture of the corporates. Two of those circles are purely about people. And even when we look into business, sometimes we do surveys, we do research on the demand side, which is many times consumers. We have to build some hypothesis on consumers' behaviors. The two most important principles for your question is when it comes to analyze people. For example, when I research on the founder of a company, ordinarily you would think it's the most direct way to interview the person themselves, to talk to them. But this is it's very difficult to get such chance. B, it's not as helpful as you think to get to the truth. Sometimes the founders, the key person, the key management could be very persuasive or even deceptive. You have to be very careful when you directly talk to them. And sometimes there is compliance issue. So what we do is to get around and try to interview people around that key management. For example, there are one-downs within the corporate or the long-term business partners in the supply chain, their suppliers or their franchisees or their customer, their long-term customers, or even some financial institutions that do business with them. Their banks, their security firm, their IPO underwriters, and sometimes they're even government officials that regulates them. Those people probably have more insights, more true observations on the key management. So that's the direction you should work. We usually work on.
When you think about integrity, do you think about positives or the absence of negatives? When you do these interviews, are you trying to see, like, is there a problem? Mm-hmm. Or are you trying to look for some virtue?
For integrity, I usually look for red flags, because red flags integrity usually would be deal breakers for us, because we are minor shareholders. It's a lot easier to get fooled, get cheated by the listed company than compared to significant shareholders. We don't have a board seat to supervise or anything. So especially in those some industries with a lot of information asymmetry, such as in agriculture, it's very convenient to lie for the company to avoid risks of fraud. Identifying red flags, integrity is crucial to us.
Obviously, to be a hedge fund manager, you have to be very analytical, and it's clear that rigorous analysis is core to your DNA. But investors are people too, and we're not 100% pure rational machines as maybe we sometimes have to present to our LPs. How do you integrate humanity into your work as an investor and your firm?
I will divide my answer into two parts. One is on the investment side. Like I said, we pay a lot of attention and analysis on people, around people, whether it's key management or the whole organization. The reason why we put so much efforts on people, researching on people, is because as long-term investor, as a long-term strategy, I genuinely believe that people is entrepreneurship and people within the organizational structure, architecture of a corporate are, in fact, the ultimate origins of value in creating.
Value comes from people.
Yeah, exactly. And it's the single most important factor for long-term investment, whether it's in public market or from very early stage, right? It's even in the earlier stage you got in, the more important people factor would be, right? That's why we have all those subcategories for key managements and for organizations. We evaluate the integrity, the strategic thinking ability, the execution of strategies of key management, their leadership, how they co-work with each other, whether the key man of a company is generous enough to to attract talented people, right? Whether their their ESOP plans are suitable for the growth of the company. And we also evaluate the culture, the incentive mechanism within the organization, the talent pools they have, and the human resource turnover ratio and stuff like that. I quoted a famous remark from a very well-known academic in China, Han Qide, which goes, science and technology is the engine to human being, but humanity is the wheel. For example, you can find a lot of wisdom and inspiration from history. Certainly, there are certain beauty in arts, in literature, in poetry, and sometimes reading books in philosophy can be very mind-clearing and very soothing.
Tell me about the literature and the poetry that you've been reading, and how has it opened your mind, or what inspiration has it given you? And has there ever been a moment at work where you're, looking at a company or considering an investment, and all of a sudden you think to that, Song Dynasty poem that you read?
I spend at least one day of every weekend in my office, and usually I will spend 1 hour or two reading some humanities related books. Recently, most of them are about poetry. The words are very beautiful. It's very intricate and very sometimes very subtle, sometimes very expressive, and it just gives certain beauty. I certainly don't want my teams to be overwhelmed by all the negativities, which is very common nowadays in this world. And also they turning to someone whose sole purpose or sole interest is to pursue a profit or commercial success. I want them to be more complete, full of humanistic care I think that's really who we are. Also, I want them to be physically and mentally, psychologically healthy to be a winner in the marathon of long-term investing. So that's the whole point.
That's a nice way to think of a portfolio. It's not a portfolio of assets, cash flows. It's also a portfolio of truths that I have collected through this hard research. They're like little gems that I found, and they shine with truth. And, it's a little selfishly, I gather them up, and these are my truths. These are what I know to be true. I have this portfolio of truths.
Yeah. I know it's a little bit idealistic to think we hold a portfolio of truth, but of course people make mistake. We make mistake as well. Although we like to keep a concentrated portfolio, which is easier to gain alpha, we have to keep it on some level diversified in case we made mistakes. We believe by using the proper framework and processes, and also doing every step with disciplines, we will have higher possibility, a little bit higher possibility of getting the truth than others. That would be enough for us to get succeed.
Any wisdom, lessons learned about your partnership, maintaining a strong partnership and finding the right person to key man with?
I think the most important rule I follow is to understand every relationship requires constant efforts and mutual efforts and constant cares. Don't take things for granted. It's actually very similar to your intimate relationships. It needs constant care, constant investment from both sides, whether it comes from honest discussion, sometimes healthy debate, sometimes team building, going out somewhere, sometimes interact with their families. It all requires your attentions and time. Pengfei and I really very much admire the relationship between Charlie Munger and Warren Buffett, and hopefully we can live as long and have precious relationship like theirs, and do investments till we are really old and stupid. Hopefully, that's really the life that we admire. And I understand that that's not a given. It requires attention and efforts. Yeah.
Well, it's a beautiful dream. Here's to it.
Thank you.
Thanks so much. Thanks for listening. To support, please check out the links to our sponsors in the show notes, follow me on LinkedIn, and of course, subscribe to The Essence of Investing wherever you get your podcasts. With that, I am signing off, your happy and humble host, Jonathan Reckman. See you next time.